The average cost of full car insurance went up 26% in 2024. Car insurance costs have been on the rise, leaving drivers searching for ways to save on car ownership costs. In fact, according to a report from Bankrate, the average annual premiums of full coverage auto insurance rose to $2,543 in 2024, up 26% from the previous year. And it's not just 2024. Car insurance rates are way up over the past few years, and that's frankly because the auto insurance industries and the companies in the industries themselves are losing money. So let's go over the reasons they're losing money, and at the end, I'll go over some ways that you can save money on car insurance if that's something you're looking to do. Now, the main reason for the increase is that the car insurance companies themselves are not turning a profit, so they're raising premiums to try and make that happen. As you can see from this article from the from the Insurance Information Institute, it gives the reason that car insurance companies are not making money to a very interesting cause: legal system abuse adding to the increasing auto insurance costs, creating a new asset class of investors betting on litigation. The Insurance Information Institute, the trusted source for data-driven insights on risk and insurance, today released its latest issue brief highlighting how excessive litigation is compounding a years-long problem of rising auto insurance costs. As dangerous roads and driving conditions as well as economic costs have been on the rise for the last several years, the challenges presented by overzealous billboard attorneys are exasperating the situation, as insurers last year, on average, and this is very important, paid out more than $1.10 per every $1 in premiums they collected, according to the brief. So this report is saying that attorneys are constantly suing these auto insurance companies trying to get extra money out of settlements, and that litigation cost is forcing those brands to raise their prices to try and be able to pay for all the lawyer fees. Now, this report, of course, could actually be biased. So I looked around on the internet to fact check it and see if specifically this number that for every $1.10, for every dollar they collected in premiums, they paid out $1.10 over in claims and court fees and so on and so forth. And then I stumbled across this. State Farm reports monster loss for 2023. So this report is just a little bit older, but this section is the most interesting. In the auto insurance sector, State Farm reported an underwriting loss of $9.7 billion, with homeowners, commercial, multiple peril, CMP, and other lines experience a $4.7 billion underwriting loss. The health insurance sector reported an underwriting loss of $106 million, while the life insurance sector saw a net income of $1.2 billion in 2023. And it's not just State Farm, but Geico as well. I found this report that says Geico State Farm report billions in loss from auto insurance underwriting. Both Geico and State Farm have reported billions in 2022 underwriting losses, but have differing business moves and outlooks for 2023. In his annual shareholder letter, Berkshire Hathaway chairman and CEO Warren Buffett said 2022 was, quote, a good year for Berkshire, and offered a bright outlook for this year. The dozens of businesses that the company owns generated $30.8 billion of profit despite rising inflations and supply chain disruptions. Geico, a subsidiary of Berkshire, however, had nearly $1.2 billion in currency losses, and specifically in car insurance, experienced the sixth straight underwriting loss despite increasing premiums, reports Reuters. So it seems like auto insurance is going up because as an industry, it is not expensive enough to actually be turning a profit. Even the big companies like State Farm and Geico are losing money on this. And these big companies are for-profit companies. They have shareholders that they're beholden to, and as such, their primary objective and their priority is to turn a profit. So that's what they're going to do by raising prices. See, often when prices go up, it's because the corporations behind them want to make more money, and so it's very reasonable to call those companies greedy. But here, it is hard to call them greedy when they're actively losing money on the auto insurance sectors of their companies. So basically, at a high level, auto insurance isn't making money. And as a result of that, premiums are going up, which of course begs the question, why is it not making money? And there are several reasons for that. The first reason we should talk about is the fact that there is a major mechanics shortage. TechForce Reports reveals demand for vehicle technicians continues to outpace supply by nearly 3-to-1. This means for every 3 mechanics that are needed in order to meet the demand, there's only 1 mechanic actually entering the workforce. Overall gap in supply and demand of transportation technicians continues to grow despite slight uptick in diesel certifications. Although demand is strong, with 640 42,000 auto, diesel, or collision techs needed between 2020 and 2024, the shortage continues to worsen. The good news is that these careers have been deemed essential by the government, and the transportation industry is organizing to do something about the shortage, said Jennifer Mayer, the TechForce CEO. TechForce's campaigns are leveraging the industry's collective voice to inspire the next generation of technicians to address the root cause of the shortage. So if there are not enough mechanics, that means the mechanics that do exist are overworked, and because they have too many jobs and not enough time to actually work on the jobs, they're going to raise their prices to try and get the number of jobs they have to come down, which drives up the costs that the insurance companies have to pay out in order to get these vehicles fixed. And in addition to that, with fewer mechanics also comes longer wait times. So often insurance companies will pay for a courtesy car or a rental vehicle while a car is being fixed in the shop. If you have to wait an extra 3 or 4 days for your car to be fixed, that's 3 or 4 days of rental car prices that they're paying, which might only be a few $100s, but that's a few $100s per person. When you think about the tens of millions of cars that any one insurance company is paying for, that's a lot of money that they're losing to rentals. And also just generally, the price to fix cars is going up because with computers in them, cars are more complicated than ever, and it's more difficult than ever to actually diagnose and fix issues. Now, the second reason that insurance companies aren't making money on auto insurance is that the price of cars across the board has gone up substantially. The used car market is tracked here by Car Gurus, and as you can see, it was trending down for a while, and then in the past couple of years, there's been a huge spike in the price of used cars. Sure, it's come down in just the last couple of months from the high of 30,000 down to where it sits now at about 28,000, but that's still so much higher than it was in 2020 when it was at basically its lowest. So when you have the price of either buying a new car or fixing old cars or replacing cars that have been totaled going from $20,000 up to like almost $35,000, car insurance companies, if they're not raising their premiums fast enough to keep up with that, are eating those extra costs. And that is one of the things that's been happening. And it's not just the used cars, even though most people drive those. It's the new car as well. The US new vehicle prices are down year over year for the third straight month, which is great to see. But when you look at the numbers long term, they are still way, way up, starting from about maybe $31,000 or just a bit over $30,000 here in 2012 to $48,000 here. Probably insurance premiums have not been increased by the same percentage that new car prices have been going up. And so when a new car is insured and then totaled, it costs way more than the policy is actually worth to fix that car. So with cars in general getting more expensive and the cost to actually fix the car is going up because cars are more complicated and there aren't enough mechanics, the premiums themselves have to go up to try and match these industry standards. And that's not the only two reasons. The third, and one of the big kickers, is the price of health insurance. Health expenditures per capita, as you can see, have been going up, and I'm sure you're not surprised by this, by a tremendous amount, with a tiny dip in 2020 because there were some government programs to help people out, and then it's on its way back up. This data is actually directly from the U.S. Bureau of Economic Analysis, so it's pretty reliable. There's not, this is the most recent data I could find. So with healthcare costs going higher, when there is an accident, the auto insurance companies are having to pay out more money than they ever have at any point in history to cover the medical bills of either the person that was hit or the person that they're covering. And all of these issues that I've had, not enough mechanics, prices going up, and also health insurance going up, are exacerbated by the fact that we are near historical highs for car crash and deaths rates. This is the deaths and population rates between 1913 and 1921 for car accidents. As you can see, by and large, it's been trending downwards, but in the past few years, past decade-ish, we're seeing it rise substantially. So there are more accidents per capita than we have ever seen before, and those accidents are more expensive to fix than they ever have been before because the cars are more expensive to fix and the healthcare costs are more expensive to cover in order to cover the drivers or the people they hit that are in the hospital. All of these factors lead to insurance companies needing to pass those costs on to somewhere because they're not making money, and even if they were making money, they would be unwilling to make less money than the previous year because they've got shareholders that they have to please. And as a result of that, they're raising premiums. So if you're one of the basically everybody in the United States that is seeing premiums go up for you, I have two main pieces of advice that can try and help you keep those premiums down. The first piece of advice is to just shop around. Lots of auto insurance companies are betting on the fact that you won't go through the hassle of trying to find new insurance. Every year, there, shop around, and try and find your policy at different price points that are less than what you're paying. And then if you don't want to switch, you can take those offers to your car insurance company and ask them if they could match it. And if they can't, you can just switch. And when you're shopping around, don't just look at the huge ones like State Farm, Progressive, the other ones that are big, Geico, and so on, but also look around and see if you can find local auto insurance companies that might just exist in your state. They might have better customer service, maybe people in your community that you know work there, and they might be able to beat the prices of the big company. The second piece of advice is see if your insurance company has any kind of a drive safe and save type program. Usually what these are is they put a tracking device either on your phone via an app or in your car that will measure things like how fast you go, how fast you accelerate, how quickly you stop, and it will use that data to form a score of how good of a driver you are. The better of a driver you are, the lower your insurance premiums are because you're far less likely to get into an accident. I understand there can be a potential privacy issue here, but if you're a good driver and you're really strapped for cash, this might be a good way to go. And if you're looking for a whole insurance company that bases everything in their insurance model off of this, you could look at something like Root Insurance. I'm not sponsored, I'm way too small for that, but it's cheap car insurance that is smart. And basically what you do is you get this app on your phone, you drive like normal for a few weeks, you get a score from Root, and if you're a good driver, then they offer you an insurance policy where you save a lot of money. The idea being they track everything about how you drive via your phone, and then they decide if you're a good enough driver to be on their policies. And if you are, then you get a quote based on that. I have used Root in the past, and it gave me an 8 out of 10. That seems about right for me, so if it's something that you are interested in looking for, you might be able to save a few $100s here, and it gives you some numbers like you get better rates because they basically only insure drivers that are actually good and get high scores in their app. So that's why insurance premiums are going up and something you can do to help stop it. Thanks for watching.